Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Tuesday, February 1st, 2022. What we're going to do in this video is take a look at a handful of stocks that are scheduled to report earnings both after the bell today as well as tomorrow. These are potentially market-moving stocks, top components of the NASDAQ 100, and many of those also in the S&P 500. So we'll take a look at those and you see what the charts are saying. Quite often, not always, but quite often, if the chart is clearly bullish or bearish, that's going to indicate which way the stock is going to go after earnings. And I'm not talking about the initial reaction, but more the lasting reaction, the next, trend. All right, before we do that, we're also going to just do a quick update on some of my indicators, sentiment indicators. These are ones I've shared in the past and just figured I'd update them. This one here is the CPCE. That's the put to call equity put to call ratio. So this measures the ratio of put buying versus call buying on individual stocks. So it's not including the indexes. And I've put this line here, something I noticed a while back, at about the just over the 0.60 level, about 0.61 or so, seems to be when the 100 period moving average, simple moving average. I do that because it smooths out, the put to call ratio, looks like an erratic EKG. That's the black lines here, these spikes all over the place. So by putting a moving average, it'll smooth out. The 100-day moving average kind of shows the trend, which way the put to call ratio is going. And this is a sentiment indicator. And I always say that this one is one of the better ones out there. There's sentiment indicators that will poll individual investors, such as the AAII Bull Bear survey. They send out a weekly survey to their participants, whether they're bullish or bearish. But as I always say, you can talk a bullish or bearish talk. Doesn't mean that's where, if you have your money where your mouth is. In other words, I may be all out bullish on XYZ and plan to buy it, but guess what? Something comes up, maybe I don't buy it, or I change my mind right after that survey. Whereas put to call ratios are showing where bets are being laid. Puts are being placed on stocks, betting they're going to go down. Yeah, there is a hedging element as well, but that's all factored in here. And call is a bullish bet on a stock that it's going to go up. And so when that ratio falls, it means there are more less put buying than call buying. Put buying is going down. More people are buying calls. More people are bullish. And you can see, without fail, when we've hit that line in recent years, there's a lag time, and that's something else I talked about. That lag time can be, and it typically is, up to a year or more when you get down there. But that's been the floor. So it shows that things get frothy ahead of time, and then at first it's good because everyone's buying stocks, or bullish, and then eventually that it marks the top, and that was a 58% or so bear market back then, 2007 to 2008. We didn't hit that line again until back here in early 11, and there was about a 22% drop in the S&P 500. Didn't kiss it again till right here on that dot. You can see the lines that I showed when we first crossed it. So that gives you an idea of the lag time involved. Sometimes it happens sooner than later, and actually, most of these cases, actually, we hit it there. I'm sorry, and the line shows where the market topped. That's what I was showing you, where the market topped, and you can see that we usually hit that indicator anywhere from shortly before it, or up to about a year or so. And in this case, this is the first time we hit that line. Not only did we hit it, we crossed below it and we kept going. That means people just all out, foaming at the mouth bullish, as far as sentiment goes over the last year, really, because we hit it in early 2021, and we're well below it. And yeah, we've had a correction. We had a roughly 12.8, 13% drop. But it's, first of all, number one, that pales to the previous drop, 16, 22, and again 50. I think it was 56. So these are rough measurements, 58, and I have it there. And with such an extreme, I don't think the piper has been paid yet. In other words, I think that would indicate, because of such extreme bullishness, longer term, more downside there. Maybe, maybe not. As of now, the indicators, another successful, prediction that we're going to have a healthy correction, and that's what that's been so far. The $1 million question was that it? Was that the drop with another, move to new highs to come? or is that just the initial leg down in what's going to be a much deeper correction and or bear market? All right, two more to look at, and then we'll go over just a handful of stocks, and we'll wrap this one up. Okay, here's another one. That was the CPCE weekly. This is a CPCE daily. The again put to call ratio of equities, puts versus call buying. And on the daily chart, I have two lines. I have a green line here, and that marks extreme bearishness or fear. So when the put to call ratio goes high, a lot more put buying than call buying. And down here, the red zone with the red line being right there at about the 0.38 level is extreme bullishness. And so when you hit that level, here's where you hit it back then. This is where our bull market started. We're still in this. I'm still considering this a continuation of the bull market that started in '09. Others might call that a bear market. I call it Ursa interruptus is my term for it. A bear interrupted by Powell and friends, and of course DC as well. Happened so fast. Yeah, 36% drop in the S&P, but we just snapped right back. So again, bigger picture just shows this is a bull trend. You don't have to be proficient at technical analysis to say it's a secular or larger bull market. So within this bull market, and again, when we start getting to once the next bear market starts, just remember I'm showing you corrections in a bull market, and these were all double digits. I've covered the amounts many times. This one lasted almost 2 years, over a year and a half, and you can see, boom, we hit that level, there's the correction. We hit that level, there was a correction. We hit that level, there was a correction, and that was really again the start of a nearly 2 year sideways deer market where we never went up or down. We actually several big drops within there, and so that really should all be one red zone, again triggered by that. And here's the thing, we have not touched that level until recently, and I always talk about this when I use these type of sentiment indicators. When you get readings in close proximity, I call that a cluster. This is the biggest cluster I've ever seen, meaning persistently bullish sentiment hitting that level. So it's not as if it hasn't worked out. If we go up here and we just get off that line now for the next year or so and the bull market continues, I will say that was a whipsaw. And only in hindsight will we know that. As of now, we have multiple readings, and again, it doesn't mean that it hasn't worked. It just means the bullishness hasn't abated. We've started to see a little tick up, but not nearly as much, because what you'll notice here is this is where typically after these big drops like this, you get this surge up here, this spike up to the green zone. That's where you want to buy. That's what ended that sideways or bear or deer market back in 2015 to 2016. That was a spike right there that ended the big Q4 drop in 2018. Remember, we had COVID right there, perfect kiss, well into the range. And again, so here's my point is there's no fear. We've just dropped, we've just corrected, maybe that's it. And maybe we're in a new era of, where these indicators the old levels don't mean anything anymore. That is possible. Only time will tell. I can only point out what I see, and that tells me that despite the recent drop, market participants as a whole are not afraid, and that's not a good thing. That's when everyone else gets afraid, that's when I want to start buying. So, and that's usually when a correction is over, especially after triggering one of these powerful, pretty powerful and reliable sell signals. So that's it. I'll show you one more. It's weird. I have this in my sentiment indicators folder, but it's not really a sentiment indicator. It's more of a showing overbought, oversold conditions. This is Apple. This is the 800-pound gorilla in the stock market, in the tech sector, in the S&P 500, and Nasdaq 100, you name it. Biggest company in the world, biggest publicly traded company, and you have this divergence. Oh, I missed that line there. The divergence started here. So this goes back and all the way back before even the last bear market, 2004 or 5. You can see big divergence building, and there was a big drop. That was obviously, I'm using log scaling, so if the stock dropped from split adjusted, that's about $7.50 down to about it's hard to even range 3. That means it got cut more than half right there. Okay, so big stuff. The rest of the drops are all measured out here. 45%, 44%. Again, doesn't look, is that right? 40, I have to look at that closer. I don't think that, I might be looking at something wrong. 39%, 35. And what I just wanted to point out, this is the biggest divergence that we have seen on Apple on this indicator, which again is the, if I didn't make it clear before, it's a custom indicator that I use to show the percentage above the 200-day moving average. I might not have mentioned that in the beginning. It's written down here. It's real small, but so this line, again, it will show you the percentage that Apple is trading above or below its moving average. There's a zero line, so when the black lines are on that, you're right on the 200-day. You're testing it from, in this case, below or above. And so when you get really, really far from it, that's when you usually get a little correction at that point. You did, but then you look for the divergence, and that's where the big trends end and the bear market comes. So this is it. We don't have many of these divergences. I measured them all out except this one, and I just want to point out this is the biggest divergence. So there's two takeaways when I studied this chart. Something I've noticed in the past is, so number one, you look for these extreme highs, and don't go shorting the boat because that's Apple's very strong then. What you need, like anything, divergence is a sign that momentum is waning and slowing. And so that is the negative divergence right there. And the other thing is, when you're below, when this indicator, the percentage that it's trading above or below its 200 gets down below the zero line, meaning Apple's dropped below its 200-day moving average, then you get these pushbacks to the level right here. You get the pushbacks to the zero line, meaning those are back tests of the 200-day. Remember, I've been talking about that recently on the S&P 500 and the NASDAQ 100. That is often where Apple will correct when it's broken below and then it comes and back tests. And you can see it just recently did that right at the highs, and it still has not taken out those highs. So that's something else to note that speaks to the fact that as strong as Apple's been post earnings, this chart to me indicates, despite what happens in the next day or two or week or so, that in the coming weeks to months, there's a lot more downside on that stock. Okay, now on to the stocks that are reporting both today and tomorrow. There's a few tonight. These are top components in the top 10 to 20, the top 20 or so of the NASDAQ 100. We have, first of all, Alphabet, Google's parent company here. This is there's a couple share classes. We'll look at GOG. You can also look at GOGL. PayPal, we'll look at Starbucks, AMD, and then I've got one more, I believe, let me start out here with Alphabet. Oh yeah, GM is the other one. GM's not a market mover, but I'll just cover that. All right, Alphabet. This is a weekly chart. So what I see, we had a primary trend line, very well defined, lots of distinct reactions. It came off big support right here. That's when COVID hit, took Alphabet right back to big support there. That's about 995 roughly. From there, we were very oversold. The stock rallied, and you can see had just a nice, well-defined trend line. It's been walking up ever since the COVID drop into the March lows right there. That trend line was broken. Again, this is a weekly chart. There was our sell signal, that weekly red candle down through there. We back tested 1, 2, 3, 4, 5 weeks, 6 weeks really, of back testing. Let me try to grab in the line here. Let's see. There it is. Got the line right there. And so we back tested for about a little over a month and then started rolling over. And that's it. So that's a breakdown in a back test and what appears to be an initial leg down, because that's just one leg down. There's not any decent counter trend rally until now. And again, this is possibly flagging action. Not as crazy about it here. Also testing that 200-day or 40-week exponential or simple moving average right now. So this reports after the bell, oversold, and again the NASDAQ 100 hit support, so that's when everything bounced, is because the QQQ hit that first target a few weeks ago. And so now if you want to put a line that's relevant, it's going to be that, you have to take out that low. So where does it go from here? This one, well, let's take a look at the daily chart. We can see that on the daily chart, we're well below the PPO, that 0.47, about negative 0.5 level on the PPO. When you cross down below it, that usually denotes a bearish trend change from bullish to bearish. We do have an uptrend line there if we happen to pop, and we are in a near-term downtrend. Remember, the longer-term trend since off the COVID lows is bullish, but you broke the primary trend line here on the daily. Here, that goes all the way back to the lows right there. There's my primary trend line. And then we had as we back tested that primary trend line, we set up in this secondary trend line or price channel. Let me put that right here. So remember, we back tested right here, had a secondary trend line, which we then broke, back tested that, took out this level. So there's a pretty important technical level right here. See, that's that shelf of support at about 27.97. Got a little too stretched. No more flag. I don't like the look of it now. Let's just see where this one goes. It is a market mover. There's the 200-day moving averages. The 50's right above it. I don't have a strong opinion on this one, I have to say, but based on that weekly chart, I do have a pretty fair opinion as to where we go in the coming months, the coming days, weeks even. Hard to say whether we do that or just crap out. If we crap out, that's not going to be good for the NASDAQ 100. And if we have a strong gap up and it moves the NASDAQ 100 up, well, it's not going to help the bearish case, but at least we've got a little room where I have some more upside on the potential bounce target zones on the Qs. It's not going to hurt it until unless we start to get above those levels on QQQ. Remember, this is just one company, although it's a big one, so we'll watch that tonight. Next one up is PayPal. They're going to report tonight. This is PayPal. This one actually has some nice bullish divergences right here, positive divergences, just like you had negative divergences here at the highs. You had a divergent high right there, and you had a 28% correction. That divergence only got bigger, and now we've had a much larger correction. This wasn't random. This was factored into the charts. It was highlighted. I'll show you a second ago. I covered this one way back here. And so here's my thoughts on this one. If I was only looking at the daily chart, I might, and I have to acknowledge this. This is bullish divergence, and we could pop. And you have a nice trend line here, decent. It's not great, but decent trend line. But mainly, you have that bullish divergence. You're very oversold, and if the overall market's in a longer-term bull market with a lot more upside, we're probably going to pop this, and this is going to be one of the better-looking trades that you can go long for the coming. Weeks to months. You could even position here. It's going to report tonight. You might as well just wait till the earnings are out of the way, unless you're a gambler or you want to take a partial position ahead of time in case there's a gap up. But on the downside, you still have a big old gap here and big support down here, 124.13. That's where, despite what happens to earnings, I could see a pop up to this level. I think we're still going down. In fact, I'm going to show you why. Well, let's talk about it here. We go to the weekly chart. This is PayPal weekly chart. No, loop back. This is a video I posted back on September 30th of last year. So that's, what is that, 3 months ago, 4 months ago. And this is the weekly chart, same one I'm showing you. These are my annotations from the video, not right now, but I'm just going to go over them. I showed you this long-term trend line. The stock had just come off that divergent high, and I showed us coming down to this trend line. And so far, we were at, hard to see in the video, it's 259.34 or 259.24 the stock was at the time. And let's see, go from there, 259. There's 260, close enough. So far the stock's fallen another 41%. And the thing is, it's come close, but it hasn't hit my target. I had it going down here, and I do believe that target will be hit. I talk about these long-term trend lines. They're like magnets. When you get too far away from them, like you did here, you're going to come. So to me, this one's a matter of, are we going to come zigzag, have another, a decent counter trend tradable rally first or not? If we do, big resistance. I gave you those levels back in that video in the end of September there. That's a possibility, especially with those daily divergences. And it's probably going to mean that the NASDAQ has some more upside. I doubt that PayPal is going to rally total of about 25 to 30% without the NASDAQ 100 at least holding up, consolidating, going sideways, and more likely rallying. And if not, that's the thing. If we just crap out and those divergences do not play out on the daily and they get burned through, that's indicative that's bear market action. Now, you can say what you want about the stock market. That's, nobody's calling that a bear market yet. I think it might be in the early stages, but it hasn't fallen enough. But this one, this guy's off 50%. The stock has got cut in half. If you bought, at the highs back here, just before that video, you've lost half your money. And so that's, and many other stocks are in bear markets. It's those market leading fangs that just are holding this whole thing up. Okay, next up, I might have covered Starbucks in that video as well. I'm not sure, but here's my weekly chart of Starbucks. Here's another stock that has long since peaked. This one peaked back in last towards the end of July, and Starbucks has already fallen 23%. All right, so where does it go from here? Well, it's a weekly chart we're looking at. What stands out to me, very impulsive move down, followed by a little counter trend bounce here, right off support. About 96.95, about $97, right, on this weekly. But that's looks like a bear flag to me. So if that thing does play out, if this one craps out for earnings, there's a measured target. It's going to take us right down. I have a support slash target zone here at about 79 to 82, and that's where I think that one's going. Otherwise, as I often say, support is support until it's broken. So, you need to see that to get taken out. So there's a potential trade idea. If it craps out from earnings, you want to see what happens tomorrow. Don't read too much into what happens initially. There's your little flag on the daily chart, and that'd be your, that should take us down here at about, I'd target about 82 right there if you want to short Starbucks. There's some support there, about 91, pretty decent support. But ultimately, if we break down from the flag, if it craps out after earnings, I'd call it down to about 82 right there. And on the bull side, there's no divergence, but you do have the PPO trying to turn back up. It's about to and oversold. So you can credit that. If we're in an ongoing bull market and that's just a big correction within a bull, you want to buy oversold. Oversold is when you want to step in and buy. That's what happened right here. But in a bear market, the problem is oversold tends to become more oversold and or stay oversold for an extended period of time. So you just keep going down, you get oversold again, it keeps doing that. Just like in a bull market, you see overbought tends to become more overbought, and you get frequent overbought readings in a bull trend. Next up, AMD, big semi, and I did get feedback from at least one member of the site that said he'd be interested in some trade setups. So I will do that. I'm working on going through and culling down my the components of the semiconductor sector to a short list of my favorite trade ideas, and I'll post those soon. There's AMD. Here's a story of AMD. Nice, clean up trend line. It was very clean to that point, broke down and back tested, but the semis they were given a second breath of life here with just the huge demand for semis. And again, it's the question of when's that demand, when will supply catch up to demand? If demand stays strong, it's going to take longer. If all of a sudden the demand drops off for various reasons, then you could see a quick turn in the semis. So it broke down, and then it had this secondary trend line underneath. It was back testing for a while, popped back in, even regained the trend line twice, but then put in a big divergent high there, and it's been falling since. I color coded this line yellow to keep it very simple. 99.60. That's the magic number, I believe. And we have that was a major high there. It was an all-time high at the time. We broke out and it was bullish. See that impulsive buying breakout. He had a successful back test of that breakout to all-time highs, and just again the other day we hit it. So if we break it, it's big support, and it's also going to mean a failure of the breakout to all-time highs. It'll also mean that we're back below the trend line, so that in itself puts on a sell signal. Problem is you're just above support now, and to me it's a matter of, do we have another back test, or is that it? So let's see what happens after earnings. These are stocks to watch, and again, whether you're a bull or a bear, it's all a game to me of check marks, probability, and odds. So let me do that another way. Here's what a bull wants to see. They want to see this thing rally off that level. We already had a successful backtest. You could have stepped in and bought here. You could buy it right here today if you want. If you want to take a risk in front of earnings, and have a stop below there and let it ride if you're a bull. And a bull wants to see each of these levels get taken out, and those are check marks for the longer term outlook, for bullish outlook. Whereas a bear wants to see it drop below 99.60, and then it's going to move down. It'll hit my next target is 73.77. From when that gets taken out, 59.14. We look at a weekly chart. That's the same thing I just showed you. Big long-term primary uptrend line. It was very well defined. A little bit of whipsawing through it, but we're still below it. That's the important thing. This is a long-term trend line. Comes off the 2016 lows, late 2015, early 2016. Well defined. And there's a breakdown. Again, it's a little bit of a question mark because we've had a few breakdowns that proved to be whipsaws so far. That's why I had that secondary trend line. But Where does it go? On the weekly, I would say, well, there's a big level. About, the one I just showed you, the recent low is about 98.56. These are, I'm just marking this chart up now for the first time in a while. Then 72.60 and then 59.90. Those are your targets there for AMD. Keep in mind that's a big leading semiconductor stock, so it's going to impact the sector that I covered earlier today. And if it goes down that blue level, it's in line with what I was calling for on the semis earlier today, about a 50% drop. And they're going to report tonight. So these are all things I'm going to be watching. And near term, if most of these are bullish, it's not going to help the bearish case, and it could potentially eliminate it, not by tomorrow, but soon if we keep going up more and more and start taking out those levels that I've covered. GM, just wanted to cover this one. There's GM, has a big level here at about 46.55. That was an all-time high all the way back in 2017. And there was your breakout candle, impulsive, everything you wanted to see. We came back and back tested it here last fall. And we're a little bit comfortably above it right now, but we're coming off a big divergent high right here. That is a divergent high, negative divergence. That's the percentage above the 40-week moving average. There's the PPO, and there's the RSI. So this alone tells me whether we have some near-term upside or not, that this stock is headed a lot lower based on these big weekly divergences that you have here. And then on the daily chart, same level. I colored it about 48.66, give or take. That's why it's yellow. That's a big level to me for GM. There's your, same thing. We've been diverging for a while. It's building divergences, but we're closed today at resistance around 53.60. And yeah, those are your levels to watch. Alrighty, that is today. Tomorrow, we're almost done with the video. Two more stocks, guys. Facebook. I mentioned about a week or two ago, as I've been going through the components of the NASDAQ 100 this was, to me, the most bullish of the FANG stocks. From a technical perspective, it's one of the few that has one of the few in the NASDAQ 100, especially the market leaders, that is, top components, that has positive, aka bullish divergence, and also at a big support level there. So I mentioned it as you can step in and buy it there. 291.25 is the bottom of that support range. We hit it several times. We also did that while QQQ was at major support, my first downside target on the short trade. And just like the Qs, it's bounced. Here's what to look for. There's a downtrend line. Let me add it in here. Downtrend line that we closed at gives you this wedge type pattern. Major support there. So obviously pop it. It's bullish. These are your resistance levels. This is a big one right here. 354.80. Really want to see that contained to keep the bearish case intact, ideally. Again, it's only one stock, one company, but that's where really any bounce should be contained if we're going a lot lower. And then should it crap out after earnings, again, a break below the recent lows is going to be ugly. It's going to take out and burn through the divergences, and that is a signature of a bear market or a serious correction when you have bullish setups, perfect looking bullish setups that fail to materialize and divergences get burned through, or breakouts, whether you don't break out or you do break out and it's a whipsaw. That's bear market action right there. So look for that. And bull market action is going to be that, hey, dip buyers come here aggressively like they bought Apple after earnings, and they can keep going. Long term, this is what Facebook looks like long term. This is bigger picture stuff. I have a primary trend line. We briefly whipsawed down through it when COVID hit, but it's had a lot of distinct reactions, and we're dancing on it right now. So that's the story of Facebook, and this is why I use multiple time frames. We can all see what we want to see, and I'll recognize a bullish development or chart pattern on a short-term chart, but the long-term charts take precedence. So there's a major bull market uptrend line in Facebook that we hit the other day when we bounced, and also major price support about 304, big price support. So a drop below there is lights out, in my opinion, for Facebook and probably the market, and that'll take it down to 249, and that would be a drop of where we are right now. If that 249 longer term targets hit, that's going to be a 22% drop, and that's about in line with my next targets on the QQQ. One more. Qualcomm reports tomorrow as well, also after the market closes, just like Facebook. This is the weekly chart. I believe I covered this in the video, semiconductor stock video today. Big divergence building. This is a weekly chart I started out on. the percentage above its 40-week moving average, the PPO, and RSI. And the last time we had divergence on all three was right here. You got it, right before COVID hit. I always said COVID, the drop was not a random event. Yes, COVID was a black swan event, but a lot of charts were pricing in significant corrections. So this was a divergent high. I'm going to measure it for you real quick. Qualcomm fell about 40%. The previous divergent high here on the weekly, we had about flat line, almost divergence there. I'm not going to put that there because it's slightly higher high, but you had RSI divergence, and the stock fell also about 35%. And likewise, you look for these divergent lows. They're bullish. That's when you want to be buying the stock. You can see divergent low, bullish, bullish. That divergence extended. We put in a second equal low, kept that bullish divergence going, and that was a catalyst for this uptrend. So wash, rinse, repeat. We are coming off a divergent high. We've already rolled over. The divergence is confirmed in place. And here's a potential. If we pop it here, it's only going to extend the divergence, at least anytime soon. We'd have to really move a lot higher to take out the divergence by taking out these previous highs. So there's the outlook on a longer term perspective. It's hard day to day. If you're short this market, and you're short during, coming right off a tag of support last week, that's what counter-trend bounces look like. They're going to make you second guess your position. That's why you shouldn't be all in right now. Of course not, because we just hit major support. Wait for that support to break, or wait. The two places I think it's time to be all in back short is either rally to the top of my bounce target zones and or take out the recent lows. Those are the two times where I'd be comfortable with a heavy short position again. That's a daily chart of Qualcomm. You know what? Here's something that could happen. I just now noticed this. Well, you can see big support down here. Big support. That's a long-term target. That's called 123 right there. Also pretty big support right here at 151 right there. But what I could see here, I'm going to turn off all the lines because it's the last stock. If this one gets whacked today, number one, that's going to have big implications on the semiconductor sector. But if we can gap down and open tomorrow below this point right here, about roughly 157.50, 157.40, that has the potential for an island cluster top. An island cluster top is defined by a cluster of candles separated by gaps on both sides. So if we gap down tomorrow, I find them to be very reliable topping patterns. This was close, but you have to come below the whole island. That was a sloppy island because you were going higher high, and you never gap down below the bottom. You've got to gap below the bottom of the island, which is right here again, about 155, almost 155 and change. And then that's again just a potential topping pattern. And turn all the lines back on. If you do, what'll help confirm that top, it's a negative divergence that we just put in place. Last time we had divergence on the daily chart was right here, and from there the stock fell, and this just gives you an idea. These are just, again, this was a bull market correction, and it still fell from high to low in a matter of 1.1 months, 22 trading days. The stock fell about 27%. So there's your stocks, there's the levels to watch, and I will be very eager to see how those companies that I just highlighted end up trading today. I can see Alphabet's up right now in pre-market, but again, don't ever read too much into the initial reaction, because that is often not the lasting reaction. But this is how Alphabet's looking right now in pre-market, popping up to about 2,900. So on the daily chart, that would be the chart properties, post and pre-data, always show when it's selected. There's what we're looking like again right now, but it really doesn't matter. Let's see what happens after the conference call and into the regular session tomorrow. There's a trend line off the highs right there, which we're just right about. So again, we'll take it with a big grain of salt, the initial reaction. We'll see what happens tomorrow, and then collectively what happens to that basket of stocks that I just showed you. All right, guys, we'll wrap it up here and get the video out to you and pick it up tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.